The Nifty 50 has surged over 545 points or roughly 2.3% in just last 4 trading days. And almost all of it is on the back of one single news event, the US-Iran peace deal. Suddenly everybody is super excited. FOMO is hitting hard and a lot of you are thinking, should I just deploy a big chunk of my money right now and ride this wave? But before you hit that buy button, think about what we have just lived through. Every single day was a wild, exhausting swing because of the US-Iran conflict. You woke up to headlines about oil exploding, the Strait of Hormuz being blocked, and the Nifty crashing on every single notification. Your portfolio was bleeding, your anxiety was building, and it felt like there was no end in sight. And then, just like that, with a swing of a pen, a peace deal is signed. Crude cools down, and we wake up to a beautifully green market. It feels amazing, doesn't it? That sudden wave of pure relief. But normal is the single biggest illusion in trading. Right now, that bottled up anxiety is flipping completely into intense FOMO. And the big question on your mind is simple. Is this green run for real? And should I deploy my cash right now to ride this wave? And today in this video, we will explore the cold truth that the mainstream media is not telling you. If you treat this sudden liquidity wave as a long-term economic strength, you are walking straight into a trap. So let's sit down, step away from the noise, and look at the actual math. Welcome back to the channel. Today I'm shooting after a much needed time away that gave me a fresh, unemotional perspective on the Indian markets. And I have a quick milestone to share. After 12 months of grinding, we were finally able to monetize this channel. And it has been a long, challenging journey, so thank you all for making this happen. Today we officially introduce our members only deep dive. The way it works is very simple. Every critical macro topic will still have a free, high signal public version right here on the main channel. But the absolute technical playbook, the exact execution strategy on how to use this data to insulate your personal wealth will live in our detailed members exclusive videos. This 7-minute video that you are watching has a comprehensive 20-minute operational version waiting for you in the members section, alongside additional perks like exclusive live Q&As and direct FaceTime with me. Because cold, hard objectivity is exactly what this market demands today. The financial headlines are not necessarily lying to you. They are just selling you a short-term comfort. And look, comfort is addictive after 3 months of war panic. It is completely human to look at a 4-day rally and think, chalo, the absolute bottom is in. Let me average out my favorite mid-caps before they leave me behind. And obviously, nobody wants to sit on cash while their neighbor boasts about making 12% in a week on a random small cap stock. So the FOMO is real. But follow your emotion and you will take a dangerous cognitive shortcut. Someone famous once said, you are either profitable in market or you are an emotional fool. Our memory is short. We see spot crude drop this week and we assume corporate input costs drop tomorrow morning. If only corporate balance sheets worked in real time. Let's look at the mechanical lag that the smart money is tracking. Think back to the brutal raw material cost shock from the March to May crude spikes when the Brent was hovering at absolute peaks alongside massive war risk shipping premiums. Indian manufacturing and consumer companies purchased their chemical and energy inputs at those peak prices 3 months ago. So they are manufacturing and distributing products today using that exact hyper expensive inventory. That margin compression does not magically vanish just because a peace deal was signed this week. So it takes roughly 1 to 2 full quarters for these peak cost input cycles to fully flush through corporate inventory drawdowns. It is a standard accounting math playing out on corporate order books. Now, you're probably thinking, why short high beta mid caps when retail participation rates are hitting all-time highs and the market has massive domestic tailwinds? Yes, that's the elephant in the room. You have probably seen the massive headlines this week about both geo platforms and the National Stock Exchange filing their draft prospectus with SEBI for their mega IPOs. The media is using this multi-billion dollar pipeline to scream that Indian equity bull run is completely unstoppable. And that is what is sort of triggering this FOMO. It is an incredible narrative, but ask yourself, who benefits from creating a hyper bullish sentiment right when the largest public listing in Indian history are about to hit the primary market? And the answer is not very hard to imagine. The foreign institutional investors know this structural inventory lag perfectly. While you are looking at a short-term green chart and buying into the IPO euphoria, the FIIs will use this temporary optimism-driven liquidity to systematically distribute their over-allocated positions. They are handing over their shares to trapped retail buyers at the absolute top of the valuation cycle. They love your relief. Your optimism gives them the exact buying volume they need to clear their books and exit safely. Now, this was still okay if it was a problem by itself. But to compound the problem, our domestic growth engine has just hit a major structural speed bump. The Indian Meteorological Department has officially revised the 2026 Southwest monsoon forecast down to just 90% of the long period average. An emerging El Nino has already created a severe, measurable rainfall deficit across key central and western agriculture belts this June. Now, if you're thinking, why should I care about the rural rainfall deficit when urban premium consumption is completely safe, as I read in the news? It is because you cannot look at the Indian economic ecosystem in isolation. Everything is connected. When staples like tomatoes, pulses, and milk experience structural supply shortages, food inflation spikes violently. And remember, food carries an enormous 46% weight in the entire CPI basket. So think about the transmission mechanism here. When the urban middle class household budget gets squeezed by basic everyday groceries, their discretionary surplus spending dries up completely. Suddenly, the urban family postpones buying that mid-size SUV and they hold off on upgrading to a premium smartphone. The entire premiumization growth narrative deflates. This makes current stretched mid-cap valuations utterly unsustainable. And I know you must be thinking that this is pessimistic guesswork. But believe me, this is the fundamental mechanism of corporate earnings meeting real-world purchasing power. By the end of Q2 FY27, the data points to a mandatory 15% compression in the operating margins across both the consumer discretionary and automotive sectors. This short-term rally is a sophisticated distribution trap engineered by the FIIs that is setting up for that 10 to 12% valuation correction in mid-cap. And I'm sure of one thing, that all of us are tired by being trapped of FIIs. So tomorrow morning, you must protect your domestic wallet by deploying 3 non-negotiable risk management rules. First, stop averaging down on high beta mid-caps that have structural exposure to rural demand or heavy petrochemical inputs. Second, reallocate tactical capital towards defensive large caps that possess absolute pricing power. And third, maintain an elevated cash or liquid fund position of at least 20 to 25. Now that you see these 3 simple steps, I hope you're able to protect your wealth properly and not deploy based on FOMO. Because panic is not a strategy. Insulation is. For the members of the Hedgenomist, I have just unlocked a 20-minute masterclass breaking down the specific lifestyle hedges to offset this 12% drag and exact defensive asset classes that historically shield capital during this shock. So click on that membership button and get your dose of detailed oversights. And for everybody else, thank you all for joining and you have a great day ahead. Bye-bye.